Chapter. We're talking real money.
Seriously? Are we already 9 days into a new year? Oh my gosh, how time flies when you're working way too hard. Hello, everybody. I'm Don McDonald, and welcome to another exciting edition of the Talking Real Money podcast. And now that the year is officially done, it's over, it's done, we're into 25. Let's look back a little bit at how things have gone. There was an interesting piece in the New York Times that was done by their statistics department or something like that put up these fascinating charts looking back at how things have changed in the financial world over the past few years, I guess. Is that about right?
That's about right. I mean, you've got to do these against the background. Of course, we had a presidential campaign, right?
I'm sorry, I was trying to forget that whole
we had global
thing.
conflicts. Inflation came down. Economic growth remains robust. But yeah, let's look at a few of the substantial numbers. I mean, the one that investors are going to look at is, and it always scares people, it fascinates me, the S&P 500 hit a record high 57 times in 2024. I think that's just short of 60. That's a lot.
That is okay, and that goes to a fascinating trait of our listeners and just people in general, investors, everybody, and that is every time. Remember all the times we hit those new highs?
Yeah.
Everybody would ask if this was the time to get out since we hit a new high. And then what did we do later? How many times? 57 times this year?
57 times.
We hit new highs.
Crazy.
So that was a new high every 5 or 6 days.
Divided. Let's see. There's
a little over every week.
Yeah, a little over every week. So it's substantial. But if you're an investor and an investor suggests long term, it doesn't matter to you. You're not paying attention to that, but it is a number that people do.
And what it means is that over time, I mean, I don't know how big the number is, but if we looked back 30, 40 years, you'd probably find that the market hit new highs hundreds and hundreds of times over that time.
And the people that study these things closely say it doesn't matter. They continue to hit.
It just doesn't matter.
But I know you want to pay attention.
But we're sharing the number.
I know. Okay, so how about this one? Because I mentioned that inflation has been tamed to some extent, certainly compared to a few years ago. And that has prompted the Federal Reserve to cut rates, 0.5-point reduction in September, another 0.25 point here at the end of the year. But looking forward, well, are they going to keep nobody knows, right? I mean, this is the great debate. One of the things that people will be paying attention to in 2025.
That's not even a great debate. I mean, that's just a great fact. A great fact is you don't know what anybody's going to do tomorrow or months from now. You don't know what the Fed will be looking at a couple of months from now. We don't have any idea what the economy is going to look like a few months from now. It could be incredible. It could be horrible. You don't know. And, I want to go back to the S&P 500. One of the things we do know is that the S&P 500, the biggest companies in the United States, have dramatically outperformed almost everything else over the past several years. So we do know that. And that should tell you right there that you just want to be broadly invested no matter what the Fed does or anybody else does.
And we'll talk about a country that you probably are not invested in, but you should be because it had a huge year. All right. What about fixed income bonds? This was the fourth year in a row that bonds underperformed cash. Now, that's fairly lengthy and substantial, but here's the one that the number that the New York Times focused on was the yield on a 10-year Treasury note, which is very closely watched, jumped to its highest level since May. I mean, this late in the year. So they're going to say, well, wait,
and that's really interesting to look at that because the 10-year Treasury yield went up in the face of lower interest rates from the Federal Reserve, which goes back to this question we get all the time. Well, when the Fed lowers rates, that means my mortgage rate's going to go down, right?
Nope, hadn't. Not much.
Didn't. Matter of fact, it went up.
I know. It's disturbing for people trying to buy a house. So, of course, those yields spiked in September, early November after the election of Donald Trump to another term in the White House. But that's a number that is fascinating. We will continue to pay attention to that. Now, here's another one that looking forward a bit more than looking behind. The incoming administration has promised increasing tariffs, Canada, Mexico, and China. And very soon. I mean, this is one of the
well, he says it's a day one thing.
I know.
And day one is literally just days away.
I know. So that's a number that they show here, and what that could mean. Of course, there will be retaliation of some kind, right? We'll have to pay attention to that one in this new year, right? It's going to be a big
absolutely.
deal.
But again, this did not happen in a vacuum.
No, thank you for pointing that out.
This is not a surprise. No one is surprised. As a matter of fact, some of the tariffs that Trump put in place in his first term were continued by Biden for the entirety of his term.
And think that through for a minute when it comes to markets, right? Because what do markets don't like? They don't like uncertainty. Well, in this case, they probably priced a lot of this stuff already into the prices of securities.
That's one of the 2 points I was trying to make. They're pricing it in to the market right now. And that is maybe part of the reason why the international markets have dramatically underperformed the U.S. market based on long-term history. The other thing, though, is there was an article a while back about how Foxconn, which is a gigantic manufacturer of electronics, they make pretty much all the stuff for Apple and many others, and how they're relocating, and they have been for the past several years, going back to Trump's first administration, they have been relocating plants to other countries, including the United States.
Wow, who saw that coming, right?
Which means no tariffs. No, international businesses have... It's not what it used to be. It used to be you had so much cost in building a giant plant, but nowadays the components, the stuff it's easily transportable. It's relatively easy to build a new plant in a new location. So the businesses will go where the climate is best for their profitability.
Yeah. All right. Let's talk about something else that's fascinating. This is a wonderful chart to look at, and that is consumer sentiment. Now, if you're a Republican, guess what? Oh, boy, you're feeling great. This is a fascinating number.
I do. I found that number to be probably the most interesting one in the story.
It really is.
Because over the past few years, the Democrats have had a much more positive outlook on the economy than the Republicans. The Democrats thought the economy was great. Republicans thought it was terrible. Now looking ahead, Republicans think it's going to be great and Democrats think it's going to be terrible.
Interesting how that works, right? Oh, guess what? We're going to be running things and it's going to be really great. The truth, probably in between there somewhere. I mean, could be really great or could be really bad. Yeah, that's absolutely
the funny thing about the truth. Is many, many years ago when I did regular talk radio, I came up with this concept. I thought, basically in life, the truth always lies. Eventually, inevitably, between the extremes.
It always, with
your kids. With your kids, it was like, no, okay. Yeah, you weren't totally innocent. You weren't totally to blame. The truth is between those extremes. And I wanted to start a new political party called Middle Truth. Middle Truth? Because the truth is always in the middle.
All right. Well, I'll tell you one thing that was not in the middle, but that skyrocketed was crypto in 2024, right?
The price
of Bitcoin, the incoming administration promising to make the United States the crypto capital of the planet. And Bitcoin surged to speaking of record highs, several times. Yeah. Boom, bang.
Yeah, I think that's a topic. I think that's a broader topic for a future podcast. I believe that is worthy of. We haven't done it in a long time. I think in an upcoming podcast, we probably should spend a little more time on crypto again. We need to revisit it. We need to revisit it because it's become big. It has.
Well, it reminds me a lot of when it all kind of got going a few years ago and the number of calls we would get on a live Saturday show. It was a lot for a long time.
And then it went away. And, it was coincidental. Those calls went way down when the price went way down.
Yeah. And then they turn around, they go back up again. So that's a fascinating number. Not related directly, but speaking of speculation, NVIDIA. I mean, it overtook Apple and Microsoft to become the most valuable company in the world.
Which
crazy.
Which makes no sense because they build almost a commodity device. Their processing units. They're basically computer chips, fancy ones that were initially used to process the complex graphics on computers, particularly video games and the like. But because of that ability to process very quickly, they became the go-to product for building out AI. But it's an area where it takes a while for the competition to get factories and plants up to steam. But I just don't believe that, like anything else, one company's dominance in a very narrow field can continue when there's competition out there in the world.
Now, here's a chart if you're interested in business and what the future could look like, and that's mergers and acquisitions. Fascinating that it fell dramatically in 2023 globally to a 10-year low, M&A, a rebound of about 8% in 2024, but still, and maybe this is always true, worries about what's ahead with the global economy, geopolitical tensions, et cetera, uncertainty from elections, all that kind of stuff. But we did get a rebound in mergers and acquisitions. I'm more interested, frankly, and they didn't include this here, in the number of companies that are going public and the more and more firms that are just deciding to stay private, that are
like Nordstrom.
Yeah, that just went back and buying back their publicly traded shares. That, to me, is a fascinating number to see what that means in the future, because we do get into a regular debate about the fewer companies that are now publicly traded, and how do you invest in privately held ones?
You can't.
You really can't. But you and I can.
We're Nordstrom.
Not Nordstrom.
No. But on Nordstrom, I mean,
Nordstrom. No.
If you think Nordstrom is going to be great in the future, you go, oh man, they're turning things around. You can't participate in its growth.
Yeah, no way to do that.
Unless you're a member of the Nordstrom family.
Yeah.
Or their
good luck
bankers.
with their. Yeah, exactly. So those are fascinating. And those really do explain a lot of things about the economy in 2024. And as you know, we're not predictors, but there's going to be some interesting numbers to pay attention for 2025. I certainly think interest rates will be one. I certainly think the debate about tax rates after this year will be another one that will be at the fore, right? These will be numbers that people pay close attention to. Here's the thing. You can pay attention to them, but don't make your investing decisions based on them.
Just don't try to predict them.
No, don't try to predict them. I mean, here's another number that we kind of touched on, but didn't really specifically. Yes, the S&P 500 had those nearly 60 record highs, but we've also had 2 straight years of very large equity returns, especially from the S&P 500. So this is something we touch on almost every show, it seems like. The future is unknown, and you should be rebalancing if you didn't already at the end of the year.
Actually, I have to take back all those comments I've made over the years. In some respects, the future is kind of knowable.
Oh, good point.
It's kind of knowable. When you have several back-to-back years of substantial double-digit returns for a market, you know. You
gotta know.
You know for a fact that will not continue, that your average annual return for equities isn't suddenly going to go to 22% per year from here on in. We know that something is going to happen, and it's called reversion to the mean.
Wasn't there that expression, trees growing to the sky or something like that? Which I used to believe until I moved into my new place, and
then they fell down.
They do grow to the sky, and then hopefully they fall and miss the house.
Fall to the ground. Yeah. No, they do fall to the ground. Or burn trees. To the ground.
Yeah. Oof. So yes, you should be rebalancing that portfolio. Here's the other thing you should be doing in 2025 if you did not do it in 2024. You should always have a plan, what you're trying to do, what risk you're trying to take, and connect that risk to your portfolio. You should stay diversified. I mentioned a country that you probably are not invested in that made over 100%. Do you have any idea? I haven't shared this with Don. Any idea what country? You don't know.
There are a lot of countries, so a guess is not going to do me any good.
Argentina made over 100%.
Argentina, nothing in South America was on my list.
Okay, there you go. What was just off the top?
I was going to go Asia, possibly, or maybe I thought, okay, let's go out on a limb and say Eastern Europe, something like.
I don't even follow the markets there, so I don't know what's going on.
You don't follow the Latvian market?
Not up on what's going on right now in Romania. Sorry to say. And that brings me to the final one that should be on your list for 2025, and that is ignoring the news when it comes to your finances. You can watch and read and do all that stuff, but do not respond. That's where the trouble always starts.
Always starts. Yeah. You cannot use what's going on today to predict the future. Oh my gosh. The Latvian stock market?
Big.
Up 35% since the beginning of 2024.
I don't know that we're invested in Latvia either. I'd have to go back and look, but I'm not sure.
Oh, maybe in the emerging markets fund.
Yeah, maybe.
Wow, pretty good market. I don't know.
I hope I was part of it all. So, all right. Let's go
questions?
for questions. Oh, we're getting a lot of questions too. By the way, this is great. Love them. These are the written questions. You can always call them into Don, and you can always call in live when we do our show Saturdays from noon to 2 Pacific. I think that's 3 to 5 Eastern. But here you go.
He's a little shaky on his time zone.
Shaky on a lot of things. Frank writes us from Mullica Hill, New Jersey. Says, I have my 401k maxed out every year. I'm 40 and have over 230,000 in there. That's great. I have a 4% match from my employer. I also put money away into AVGE, which is the Avantis Global Equity Fund, and a Vanguard Target Stock, VTIVX. I know we're supposed to diversify, but I wonder if we should only be investing in AVGE and not VTIVX. Is it redundant to invest in both? My thought is if I put more into, should I put more into AVGV? I should have a better return down the road. These are two very different funds.
Yeah, they are not. They're certainly not duplicates.
No, AVGE has no fixed income or bond component to it. AVGE?
What? Oh, AVGE. I thought you meant VTI.
No,
okay.
no.
Yeah, AVGE has no bonds.
No bonds. It's
VTIVX is about 20% fixed income.
Yeah, so it's 80% in
17,
stocks.
18.
Here's the thing you get from AVGE that you don't get as well from the Vanguard Target Stock. Vanguard Target Stock is going to have more U.S. stocks, more large U.S. companies, and mostly growth. AVGE is going to tilt the other way. It's going to have more international. It's going to have more small and more value. So on the stock component, they are very different funds as well. But this is the trouble, Frank, when you say, which one should I be putting money into? I don't know what you got in your 401k, for one thing. Should the return be higher for the AVGE? Yeah, because it's all in stocks, but you're going to have to live with the ups
But it'll
and
be
downs.
lower. It'll be dramatically lower at times. And that's what the difference is that the two funds are going to move at slightly different paces. You're going to get bigger wins with the AVGE. You're going to get smaller losses with the VTIVX.
It gets you some balance. So those are very different funds.
I don't see anything wrong with having both at all.
Okay, yeah. Then maybe it's 2/3, 1/3 because AVGE is going to be more stock heavy, and you're going to anyway. So Don's right. Two very different things to own. This comes from Prefer Being Anonymous. Two-part question.
That's an interesting name.
Yeah, wanted to call Tom.
I don't think I'd name my child Prefer, but maybe Being, but not Prefer.
Easy to pronounce. Wanted to talk to Tom per his request to call him on Christmas Eve. Went to voicemail, thus this question, which is odd because I was at my desk, as Don knows, on Christmas Eve. But what are your thoughts on the Vanguard Dynamic Withdrawal Strategy? Now, I took the time to look this up. Vanguard Dynamic Withdrawal. They discussed the, fixed 4%, taking that out of your portfolio plus adding for inflation. They discussed the the dynamic aspect of taking out a percentage of your portfolio.
Isn't that our flexible, basically?
Flexible. It is similar.
Okay. That's what I thought it was, but I hadn't looked it up.
Take a look at the Vanguard Dynamic. It adds another little feature to it that to the withdrawal strategy.
Oh, it's an inflation plus percentage of
Correct.
Portfolio.
Yeah.
Okay.
So it's
a 4% rule plus a 5% flexible kind of thing.
He writes withdrawal strategy or simple 4% strategy or something like that. But as a customer, will not have to muck around with the knobs and dials of the strategy. I'll pick the rule. We could spend hours on all this. There is no correct withdrawal strategy that we know of. The only one that we know of is you'll be able to look at the day before you die and say that was the right withdrawal strategy. Mm-hmm. Then you'll know you won't.
But based on a lot of back testing, and I do mean a lot of back testing over the years, we found that I'm speaking for me, that I prefer the flexible strategy because our lives are flexible.
Yep.
And it means you have some really good years and you have some less good years. But it really has to be designed, as Tom said, for the individual.
Yeah. And the second part of the question is there a firm that will convert an accumulated pot to monthly income? Yeah, those are called annuities. But you can hire a registered investment advisor. They'll do the same thing.
A good advisor can create an income stream for you.
Less cost than an annuity, more liquidity, certainly.
Okay, now I wouldn't necessarily say less cost. I really wouldn't.
Okay, but if you use an equity index.
But with more flexibility. But what I'm saying is if you have an advisor and they're charging 1% per year.
Yeah.
That's probably higher than the internal expenses on an immediate annuity.
Immediate would be different. Yes. Okay, fair enough.
An immediate annuity,
I was speaking of
though,
one of the fancier products where you're getting, but an
immediate annuity is going to pay you a certain amount.
Yep.
You're not going to get inflation protection unless you take a smaller amount. You're not going to get joint life unless you take an even smaller amount.
That's right.
So there's a downside to everything.
Well, and literally. I would prefer to have the money be my money.
Right.
Because something comes along.
That's the difference.
You just said flexibility. Now, you never know, and this is something you and I talk about on a regular basis because we're getting older, health. So if something really bad were to happen, I want to be able to get my money and take care of my health, my wife's, whatever it is.
Yeah, and if you put it in an immediate annuity, it is gone forever.
Yeah, exactly. So I would still prefer the method of, if you want to hire somebody to do this, to hire a fee-only 100% fiduciary, that builds the right strategy, manages it, send you your check. We do this for thousands of people. And then if something comes up, they can give you your money right back. There's no restriction as to getting access to the cash. So,
plus the good news in that scenario, let's just say you are comfortable with a 4% withdrawal rate, and you can get an annuity that's paying, let's say 5.5, maybe even 6. Just say you can get that. But if you invest a portfolio partially in stocks and partially in bonds, there's a decent chance you're going to exceed that 4, 5, or 6% withdrawal rate, and your capital is going to continue to build over time. There's that potential inflation hedge in that scenario. Yeah.
So anyway, there are options, some of which I like, some of which I don't like. Don does make a very good point that an immediate annuity would be cheaper. And by the way, you get far less than you get when hiring an advisor. But
remember, it'll be cheaper, but the costs are in the lost opportunity.
Yeah, lost opportunity, flexibility, all those and help. Because with an immediate annuity, you're just getting the check. There's not somebody there to help you on a regular basis. Speaking of help, guess what's coming up so doggone fast?
Like a month from now.
I know we basically sold out the in-person part almost already. It's crazy, a month ahead of it. But you can still join us for Retire Meet 2025. I'll be
virtually
there. Don will be there.
You have to make your own sandwiches, though. I'm sorry.
So we'll send you the peanut butter and jelly. Actually, you can't send peanut butter anymore because now that might, cause somebody to have got to just tuna fish or something. No?
Oh, great. Smelly old shipped tuna fish. Great idea.
We'll warm it up for you a little bit. So, any rate, please join us. Paul Merriman will be there. Paul Lopescu. You get the idea. Herb Weisbach, all of these people there, one stage, giving you the information on a variety of things, everything from the aforementioned withdrawal strategies, portfolio design, estate planning, fraud, all that stuff you need, Social Security, and of course, Medicare, which is always very popular. RetireMeet.com is where you sign up for that. Oh, there's a very small charge to join us virtually, and the money goes to financial literacy charities. So we're not even keeping the money, but we're just collecting a little bit. And but join us. That's Saturday, February 8th. Begins at 8 o'clock in the morning Pacific time. So RetireMeet.com.
Later on the East Coast. You don't have to be up as early as we do.
Yeah. I know you just hate it because we have to get there at like 7 a.m.
I hate being up at that time of day. I am not a morning person.
No, you're not.
And if you have questions for us, please go to talkingrealmoney.com and either type them in or speak them in there. And on Saturdays, you can join us live on our radio show that airs between 3 p.m. and 5 p.m. Eastern. That number is 855-935-8255, which spells talk. So you can remember it, 855-935-TALK. I'm Don. Tom's over there. We're here with you on a regular basis, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.